All right, I'm here with Arda, and he is with short-term rental Loophole. So I got a question for you. Can you specifically say how your complete service offering is different from other offerings out there?
Good question. Most high income professionals are working with a real estate agent who finds them a property, maybe a general accountant who files their taxes, and they're just hoping the numbers work out after closing. STR Loophole, we have built something fundamentally different. We have our acquisition team that understands the investment side. We have specialized real estate CPA partners, just like yourself, who focus on exclusively on real estate tax strategy. And we have cost segregation partners who we can tap into at any point in the process. So when a client comes to us, they're not getting these three separate services that may or may not talk to each other. They are getting an integrated team that is aligned from day one. Before you even make an offer, we already run the numbers with our CPA partner and cost segregation team. So we know exactly what the cost segregation study will show. We know how it impacts your W-2 taxes. We also know what your true after tax return looks like. And that level of precision is why doctors, surgeons, tech executives work with us. They are used to operating with data and certainty. And simply put, we give them what they have been used to. And most people are doing this in reverse. They buy the property, then 6 months later, they call a CPA. Then maybe they think about cost segregation. And by then, they have potentially missed opportunities to structure the purchase price, negotiate different terms, or even walk away from a deal that looks good on paper, but it doesn't actually move the needle on their taxes.
That was great. And I will add that I loved I think you said alignment, the alignment of the people you work with, the CPAs, the cost seg studies, obviously your team, like alignment is so important. Obviously, if people aren't talking to each other, you're gonna miss stuff. There's a bunch of Airbnb gurus offering turnkey short-term rental investing services out in the marketplace. These gurus are marketing fully managed passive SDR investments with massive tax benefits for, these these high W-2 earners. These two things are contradictory under IRS rules. Can you tell me what it is that they are offering?
I actually reviewed the proposal from a turnkey short-term rental service provider. They basically handle everything: acquisition, interior design, management, guest services, completely hands off. Sounds good. But here's the problem. If they're handling everything and you are hands off, you're not materially participating, which means the STR losses cannot offset your W-2 income, which means you're not getting the tax benefit, which means the entire reason high earners invest in short term rentals just disappeared. I mean, the IRS is very clear. To use short term rental losses against your W 2 income, you must material participate. Actually, perhaps you can explain what material participation actually means and why it matters so much.
Yeah, that I can. I'll try to keep it brief because this is super important. And I will say that we are hearing that there are some headwinds out there, meaning the IRS. You now know, of course, Trump sent some IRS agents home. So, I don't know how many agents are focusing on this, but they do recognize the short-term loophole. And if you don't have the proper documentation, they will nail you. So there is a risk in this, which, people should be aware of. So material participation, there's 7 tests that you can meet. That typically we only see people meeting like maybe 3 of the 7 tests or trying to meet 3 of the 7. The loophole test that people are trying to meet, because it's probably the easiest one, is the 100-hour test. So the 100-hour test means you are spending at least 100 hours own this property, and there's activities that qualify and activities that don't qualify, i.e., if you buy, a property in another state and travel there, that would be risky to count your travel time to that other state as part of your 100 hour test. It's more think management, you're doing your own bookkeeping, paying the bills, that time qualifies. And if you're married, it's husband and wife. So you could, split that as long as you meet 100 hours. And no other individual or company spends more time than you on it. So I think one of the concerns that you might have been bringing up is, what if there's a property manager? You hire a property manager to take care of your property because you're in Arkansas and the property's in Colorado. Well, I definitely would not want to sign your tax return with that depreciation, that benefit going against your W-2 income, because there are many court cases, and all the court cases are saying you have a property manager, you are going to lose in the 100-hour test. So that, in short, is kind of, you're trying to meet the material participation. It's a 100-hour test, and it's no one else is spending more time than you. So that's kind of the two critical points with that.
Thank you for clarifying that. It's crystal clear now. This is exactly why we built short-term rental Loophole, our practice the way we did. And we are not a property management company. We don't benefit from managing your property, like for you indefinitely. Our model is built around helping high W-2 earners acquire and structure short-term rental properties so they can materially participate while still having systems in place to make it manageable. Here's what that looks like in practice. We help you acquire the right property with the right tax profile. Our real estate CPAs develop a tax optimized strategy tailored to your specific situation. Our CPAs also help our clients navigate the short-term rental tax loophole rules and ensure they are set up to document material participation correctly from day one, while maximizing your deductions and avoid any costly tax mistakes. But we also leverage our cost segregation experts to maximize your depreciation. But when it comes to operations, we help you build a system where you maintain the level of involvement required for material participation. Can you outsource some tasks? Absolutely. Cleaning crews, handyman, that's all fine. But the decision making and management, that has to be you. And we show you how to do that efficiently without it becoming a second full-time job. Most high-income earners can hit the material participation threshold with 1 or 2 hours per week if the systems are set up correctly. And we teach you those systems. The alternative would be hiring a full-time property manager, being completely hands-off, and losing the entire tax benefit. At that point, why even use the short-term rental strategy, right?
All right, I got one more question for you. You work with busy, high-income professional doctors and tech executives. How do you address the "but I don't have time" objection?
That's actually a $1 million question. Let me give you a specific example because it's going to be easier for folks who are watching us today to understand how we handle that part. One of our clients is a physician earning about $650K per year. First question, he asked, can I just hire someone to manage this and still get the tax benefits? Obviously, the answer is no. If you're not material participating, the losses cannot offset your W-2 income. That's the IRS code. So we show them what material participation actually looks like when you leverage a system. So we set him up with automated messaging templates for guest communication, a preferred vendor list for maintenance. He coordinates and they execute. Let me make that very clear. And our CPA partner provided a simple time tracking system to document his hours. He spends about an hour per week on the property. Last year, his short-term rental generated about $220K in paper losses through depreciation. That offsets his W-2 income, saving him roughly 88,000 in taxes. So 88K saved for 130 hours of work equals 677 per hour. I don't believe our physician client can bill 677 an hour in his medical practice. This became his highest ROI time. But if you would gone with a full service management company that handled everything, he would have, like saved $0 and just had another rental property. And this is why we are so adamant about structuring the involvement correctly from day one. Why is it so difficult for high income earners to find a CPA who truly understands real estate tax strategy, especially the STR loophole?
Yeah, Artie, that's a great question. When it comes to real estate strategy, experience really does matter. And here at Trout, we help investors turn complex regulations into actionable opportunities so they can keep as much as possible what they earn instead of it going to the government. A lot of CPAs know some of the rules, but very few understand all of them. And even if they do, it's hard to put it into action and strategy. Short-term rental taxation, the 750-hour real estate professional roles, the passive loss activity nuances requires more than basic compliance. It requires experience, foresight, and tactical planning. And that's where we come in. We will take the high income real estate investors, will help them maximize their deductions, navigate the complex IRS rules. Obviously, we want to stay within the rules, but we want to, do as much as possible to pay as little as possible. So when you have a portfolio that includes short-term rentals, just any CPA really doesn't cut it. You need a partner who knows the playbook.
I couldn't agree more. When you work with our clients, how do you actually build a tax optimized real estate plan around their income, goals, and property strategy?
That's another good question. We try to start by understanding, and that's by talking to you. That can help by asking you questions, but obviously asking the client direct questions about their financial, the real estate situation, whether they're just starting and they're adding to their portfolio, what other income streams they have, what are their long-term, their short-term goals. We try to put that all together and kind of map out a strategy like, hey, this is, what we would see would help you. Obviously, evaluating different type of investments, does a short-term rental make sense? Maybe you actually want to do a multifamily, a long-term rental, or a commercial, and then kind of identifying, hey, how can we optimize what you do want to do? And obviously the short-term rental loophole is one huge way to optimize the strategy. Being a real estate professional is a different strategy. And then using cost segregation study, all those things kind of together. And obviously for each person, that's going to be different. It's not going to be one size fits all. So we've really got to stay in touch with each client and kind of monitor because things change. Life happens. What if a spouse gets sick and their focus changes? We got to pivot with them and change with them.
Excellent. Can you walk through how you plug in tax benefits like cost segregation and bonus depreciation into the underwriting process before our clients even buy a short-term rental property?
Yeah, I think one thing that's helpful to think about is a lot of times people are reactive and they give their CPA, their box of receipts in April. That's too late. Like if you bought a property, if you did something that had a tax impact, we should be part of that discussion probably before you make the decision, right? So before you sign that purchase agreement, we can do a cash flow analysis with you. I know Artie's team does performas. We can look at those performas and out of it, okay, what's the property size? We can do cost segregation planning. And just to be clear, we actually don't do the cost segregation in-house. We refer that out to an engineering firm, where it's real estate focused engineers that do the cost seg study and work with us to do that. But that obviously optimizes tax deductions, depreciation, and with the OBBB change, now we got 100% bonus depreciation back in play, which is awesome. And so we can take that analysis and kind of put it into, we can say, hey, this loan, what kind of loan can you afford? What kind of tax savings can you have from this purchase? And we can kind of give the client that kind of information.
That's definitely one of our unique differentiators. What are the biggest tax mistakes you see high income earners make when they try to qualify for the short-term rental loophole on their own?
This this is right in your court, Artie, but purchasing a bad property that doesn't cash flow, like, oh great, you got a tax deduction, but it's a terrible property that you now got to try to unload or deal with for a few years. That's probably number one. Probably the next one that is more in my court would be over counting the hours. So the hours to qualify for the short-term rental loophole is typically people go with the 100-hour test. And I see things that should not be included, and I hear financial planners kind of touting them how to count, and it's wrong. But a lot of times what I see people doing is they count like the hunting for the property. They count those hours, or they count if it's an out of state property they buy, they'll count like flying down to the property. And what we've seen in IRS audits is that they will throw out that travel time. They'll throw out the pre-purchase time to like go view different properties. That just won't be allowed. So that's definitely another one. Misclassifying the rental type. Now, this is a big deal because we're trying to fit in the short-term rental loophole, which it has to be 7 days or less. And so some people just they kind of ignore that or don't understand the importance of that. And so it's 14 days or it's 30 days. Well, sorry, you just missed it. And now it's considered a rental property, not, and so it's going to fall under a different set of rules. And and then I think kind of layering in on all of these things is not documenting stuff. Like you really need to document your hours. If you're trying to save serious money on your tax return, you should take it seriously and document and make sure that you have those records that prove the time you spent and prove the expenses to to furnish the property or whatever else it may be.